Profit and loss accounts, also called income statements. So we have to look at the main components and understand them. So here's a very simplified profit and loss account for Tesco. First of all, sales turnover, that just means revenue. Cost of sales, now these are the direct or variable costs of making the product. We can see it there. Gross profit, to work out gross profit, you just have to do revenue minus cost of sales. So there's my calculation going in there. This is in the millions as well, so it looks like a small number for Tesco, but it's huge. Expenses are overheads or indirect costs or fixed costs of running the business. So they are not directly going into the product. So cost of sales for Tesco would be things like the supplies, the Kellogg's cornflakes, that kind of thing. Expenses might be the rent on the premises that they have. Net profit is gross profit minus those expenses. So that's how you get that figure there. And that is still in the millions. So there's 6 zeros to go after that figure, which takes it to over £1 billion by my calculation. So one example, a common question is one example of an expense a business might have to pay. Here are lots of different expenses. So rent, salaries, wages. Sometimes wages can come under like cost of sales, but yeah. Utility bills, so your gas, water, that type of thing. Tax, fuel, marketing, business rates, that's council tax for businesses, administration costs, insurance, all we tend to say more fixed and more indirect costs. They don't go into actually making those products or buying those products, like the Kellogg's cornflakes as I gave an example, your fruit and veg, or all the other products that Tesco sells. So more calculations that you need to know as well. Gross profit margin and net profit margin, very, very similar equations. Gross profit margin just has gross profit divided by revenue times by 100. Net profit margin is net profit divided by revenue times by 100. You want the percentages to be as large as possible. And what these both shows the percentage of gross profit from every pound that's sold. So if you're getting a gross profit margin of 28%, that means that for every pound of revenue you're getting in, it means you've got 28p of profit, which would be quite a good gross profit margin. But the best way is to show you how to calculate these. So let's go back to Tesco's profit and loss account. So the gross profit is 2,854 million. The gross profit margin, we'd have to divide that by the revenue and times it by 100 to get percentage. So they've got a gross profit margin of 5.2%. Supermarkets, we tend to find have really low gross profit and net profit margins because they're just, the way they're making profit is they're selling in such huge quantities. A smaller, maybe high value products. I'm just thinking of like a wedding dress shop. They'd have a very high gross profit margin and probably net profit margin. But overall, dress shops would be like small, independent, local retailers. So making a lot less profit overall, but the profitability of each product would probably be quite high. Net profit was 1,046 million. So your net profit margin, you're doing pretty much the same equation, but you're using net profit divided by revenue times by 100, and I've got that coming out as 1.9%. So just under 2%. So 2p from every pound of revenue that Tesco's making in net profit. The net profit is the one that gets taxed and then it can get distributed to the shareholders as dividends. So only 2p they're making as profit, but they're selling so much. I mean, I'm not going to feel bad for them because look, they're making £1 billion. So why are profit and loss accounts important to businesses and their stakeholders? So for the business, they can set themselves targets, they can measure performance from one year to the next year, they can also check their performance against competitors' performance, particularly gross profit margin and net profit margin as well, their profitability. Potential investors are going to want to look at the profit and the profit margin, see if it's a good investment. Government legally require LTDs and PLCs to produce profit and loss accounts, and they are going to calculate how much tax they owe to the government as well. Banks would want to see profit and loss accounts to decide whether a business can actually pay back debts as well. They might want to see other documents like cash flow as well. And workers, possibly, I don't know many workers that look up the P&L accounts for the company they work for, but they may want to check on the profits to help with wage negotiations. That would be a really good one. You would be able to do that now, having this knowledge of GCSE business. So this is a typical past paper question. Identify 2 stakeholders that would be interested in the accounts of Home Retail Group and explain the reasons why they have an interest. So in the case study, it does go through who Home Retail Group are. They own Argos. But to answer that question, you just have to pick 2 of those and explain why they'd be interested.